Hello, my name is Steve Bigelow with the Candlestick Forum. The markets are still in a slow, choppy uptrend, but it's in an uptrend. The Dow, as you can see, did a little J-hook pattern at the 50-day moving average, implying that this wave and this wave is likely to take you up to test this upper resistance level or the recent tops. What that implies is there's a few more days to the upside at least. At the same time, the strength in the Nasdaq has been created by these J-hook patterns using the T-line as support. Today it sold off a little bit, but then finally closed higher, still implying that our uptrend remains in progress. What the most important facet of candlestick analysis is the trend of the markets, which are much more easily identified or analyzed based upon the T line. We have just two strong, simple rules in candlestick analysis: the T line rule and the Doji rule. The T line rule is very simple. If you see a candlestick buy signal and a close above the T line, you can stay long as it stays above the T line. This is basically uh, using the investor sentiment that if the candlestick signals are the graphic depiction of human nature and the T line acts like a natural support and resistance level of human nature, when you add those two together, you've got a very powerful trend indicator. What this does for most investors, because of our emotions, it doesn't let people take profits just because they think, oh, I better take a profit because I have a profit. You can stay long as that trend works, even when you see sell signals that haven't closed below the T line. That's evident over here in Sava. We've got people in the chat room holding on to Sava because notice what it hasn't been able to do ever since it broke out down here. They've never been able to close it below the T line. This is a very simple statistical evaluation that as long as you're above the T line, the probabilities are extremely strong that you're still in an uptrend. We can see that same thing on square. It might not look good up here, but as long as they stay above the T line, or it closes above the T line, you can stay with it. Now that brings in the Doji Rule. Doji Rule is very simple. They usually move it in the direction how they open after a doji. So you're up above the T line, you're sitting right on the T line. That tells us they're going to move in the direction how they open it. So to stay long, you pretty much definitely need to see this open positive and trade positive. The other day or earlier in the week, the electric vehicle stocks started moving up, but the probabilities went dramatically against them when you saw the Doji Rule and a close back below the T line. This told you the probabilities are extremely strong that this didn't break out. You closed out the positions. You can use that when you're analyzing which sectors are acting the strongest. Look at the chart on crude oil. It hasn't been able to close below the T line ever since it broke out down here. That tells you can dramatically improve the probabilities of a trade when you see a company like PAGP, a pipeline company. Look here, stochastics coming up. You got to close below or above the T line. You broke out of this downtrend. You have a doji. If it opens positive tomorrow, you can be buying because you got a high probability situation where your doji sandwich will tell you there's more upside. You add all that together, that becomes a very high probability factor that you're probably at least heading for this level and maybe a wave 3. Same scenario on the downside. You can see Mavis had a evening star signal failure right here at the T line, telling you they aren't in an uptrend yet. As a matter of fact, it looks like a bearish J-hook pattern, which tells you if this is wave 1, wave 2, wave 3, the same magnitude as wave 1, as long as it stays below the T line, you can stay short. So right now, with the market indexes still in a slow, or not so much slow in the Dow now, it's picking up steam, but the Nasdaq getting a little bit toppy, at least you know you can stay in long positions as long as they're above the T line. You can stay short in short positions as long as they trade below the T line. That'll be it. We'll see you in the chat rooms.